From an exam technique point of view, what are we going to always do when we get a past paper?
Um, the required.
Yeah, you'd look at the required, and obviously from a risk point of view, there's a lot of multiple choice here, but there's also long questions.
Yes.
So, in a
Yes.
theory type of exam, because RSK 3701 is very theoretical, there's a lot of studying, there's a lot of detail that you need to know when actually going into the exam. What I would actually do as exam technique for a theory paper is to look at the written questions first. Okay, so here's written questions. Okay, these are true and false, section B. And normally they've got long questions covering different topics. Okay, so here's the long questions. Section C, paragraph questions. Obviously, if you're studying for the exam, it might be easier to recall all the information for the longer questions earlier in the exam and then coming back to the multiple choice. Because remember, multiple choice, one of the options will be correct. So you'll have something to go with in terms of your workings.
Yes.
It might be more challenging to think about all the theory and the detail for the long questions after you've done like an hour of multiple choice. Okay, so I don't know which method suits you better. From my perspective, when it comes to theory type of papers, so this is obviously a theory paper, there's no real calculations here. It's all recalling information that you've studied. So if that's the case, I would actually start with the written questions just in case, because it should be fresher when you get the paper. For example, number 2 is asking you about commenting on the capacity, so that's self-funding. And then question 3 is distinguish between conventional and finite insurance. Give 3 reasons. And what else do we have? Okay, question 4. Here they're talking about the COID Act. Okay, compensation for occupation injuries and diseases. And is that it? No, there's still more. Question 5. Define approximate cause and explain by means of a practical example how it may influence the validity of a claim. And there's still another one. Calculate the amount payable for each insurer. Explain the legal principle. Okay, so that's looking at probably over or under insurance depending. And then number 7, explain the cover provided under the minor and major limit of money insurance. Okay, so see, these are very specific questions. So if you haven't studied the information, it's going to be quite difficult to answer these because you need to think about all the detail. And that's why I'm suggesting for a theory paper to maybe start with the longer questions rather than the short. But it's up to you. Some students feel comfortable recalling information irrespective of whether you get it at the beginning or at the end of the exam. So it all depends on how you want to approach it. Okay, so I'm just going to approach it like a normal exam where I'm just going to go from number 1 all the way through to the last question. Okay, so we'll start with the multiple choice and then we'll come back to those long questions later.
Okay.
It's a 70-mark paper, it's a 2-hour paper, and you've obviously got 3 different sections. Let's start with section A. Okay, multiple choice. Indicate the correct answer. Okay, so choose the correct statement. Question 1, we've got 4 statements. Number 1, insurance agents sell insurance as their main occupation. Brokers may have an agency agreement with different insurers. Insurance agents are also sometimes called claim assessors. No. Loss adjusters are responsible for the settlement. No, they don't. So it'll be number 2. Brokers may have agency agreements with... Yeah, brokers can sell different products from different providers. Okay, did you go with 2 as well?
Yes.
Okay, I'm assuming you've also done these papers in advance, so at least you can also check how you're doing with the actual application.
I didn't manage to complete everything. I just started with it during the week.
Oh, well done.
Because I realized that you didn't email them to me because I wanted to double check some of the ones that I answered.
Yes. Yeah, so obviously 2015 we need to look at. So after today we'll have detailed workings and solutions for them. I am recording it as well, so I'll upload the videos later on and then you'll have that as well in case you need it. But
Okay.
yeah, really good effort then if you've been doing lots of past papers. That's the key with all modules. It's just past papers. If you can do as many as you can, it's a really good way to practice and to do well and to make sure you at least pass the exam and even maybe even get your distinction. Yeah.
Yeah.
Okay, question 2. Okay, adverse selection. Let's just recap what the concept is. So a little bit of revision. Okay, obviously adverse selection is when we have people that need insurance applying for insurance, but only when they require it. So now companies obviously don't want that to happen because companies want people to take out insurance policies way before they actually require it. Okay, so it's almost like when I'm in an accident, then I can quickly pay a premium and then I'll get car insurance cover. That isn't something that's applicable in the industry because it's going to harm the industry because insurers are going to have to pay for losses that are only occurring when they occur, and that isn't fair on them as well. Okay, so adverse selection can result in lower losses. No, it'll be higher losses. Reduced by introducing clauses such as suicide. Okay, that looks good. Number 3, refer to the tendency that people with lower probability of loss, no, it'll be higher probability of loss than the average will seek insurance. Are increased by introducing compulsory. Okay, no, it'll be decreased. If you're introducing medical exams, that'll help you with the underwriting. So the only option here that would be anything close to what we spoke about is 2.
Yeah.
Okay, question 3. A strike in the mining industry in South Africa is a typical example of a what risk? Okay, so obviously you've got different risks that the insurance industry is going to be looking at. Okay, so insurable risks, obviously insurable. Fundamental affects everyone. Particular affects specific, let's say, companies or institutions. Speculative is where there's a probability of gain or loss. So if it's looking at a strike in the mining industry, it's specific to that industry. So I would go with particular here.
Okay.
Okay, they've asked a question about Lloyd's. Has underwritten the voice of Bruce. Yeah, that's true. We were laughing about some of those weird examples that they gave in the textbook. I mean, they underwritten Bruce Springsteen's voice. That South African actress that lost her hair.
Yes.
The comedy club that was so funny that people died from laughing. Okay, those are all different like examples that they provided you with. So A looks good. Is not an insurance company. They are, well, let's think about Lloyd's. Choosing the correct combination. Lloyd's is more an underwriter, but they actually can sell insurance as well. So I would keep that aside, and let's just look at the others first. Number C, operate worldwide. They do. Invented the term underwriting. Well, yeah, they were the first to actually create the term underwriting. They were the first underwriters that started in like a coffee shop where business people met, and then they created this whole idea of insurance. Okay, so do we have an option for A, C, and D? No, we don't. So yeah, so then they would be considered an insurer as well. Okay, obviously they're more renowned for underwriting, but they can sell insurance as well. Obviously, if you're an underwriter, you would also want to sell insurance. So, I mean, it's more revenue for the business. Okay, so I would go with 1, they're all of the above.
Yeah.
Okay, question 5, a proposal form. Okay, so a proposal form is obviously that document that you get from the insurer presenting you with information regarding your policy, and then you'll accept it or reject it depending on what you're requiring. So the proposal form here, okay, so we're choosing a combination. A says is an offer by the insurer to the insured to do business. Definitely. Okay, the insurer gives a proposal to the insured and they decide to accept it or not. B, can be used to advertise other products. Yeah, definitely. They're always marketing their products to you as the consumer. C, elicits a quotation. Well, there'll be quotes on that actual proposal. They'll tell you how much the premium is. That's what you would see on those documents. Establishes a warranty. Let's think about that. A warranty would be what they're required to do. Yeah, so it would. So I would go with 1 here. It would be all 4 of those because once you accept that proposal, it becomes binding.
Okay.
Okay, question 6. Consideration in terms of insurance policies. Okay, consideration. Okay, so consideration is what you pay, so that'll be the premium. Defines the conditions of the policy. Doesn't define the conditions. Is not essential for concluding a contract. Well, that sounds pretty good, because as long as you've accepted the contract, you don't have to have paid the insurance premium yet, as long as it's paid within a certain period of time. 3 refers to terms and conditions. No. Refers to the extensions. No. Yeah, so the only one here would be 2. Okay, question 6, number 2. Right, question 7. Indicate which of the following is likely to be covered under personal accident. Okay, so personal accident is when we have, let's think about the theory now. Personal accident, harm or injury, violent harm or injury. Okay, personal accident. So if you're in a car accident, for example, and you get, you're injured and or you die from a car accident. Okay, so let's see, likely covered. Okay, so they want to know what the cover is. Okay, number 1, a man injured when picking up a heavy box. Would that have been a violent injury? No, there's no violence there.
No.
Number 2, a woman dying 2 years after being injured in a car accident. Okay, well,
No.
I like the car accident part there, but shoot, 2 years after the accident, was her dying after the accident caused by the accident or caused by something else? Okay, I'm not too sure, but let's check the others. What does number 3 say? Number 3 says a worker sustaining lung cancer as a result of working in an asbestos plant. Okay, if he gets lung cancer from an asbestos plant, that's a different act. That'll be compensation for illnesses and diseases. So I wouldn't put that under personal accident. And number 4, a man murdered by thugs on his way home from work. Okay, so it's definitely between 2 and 4. Okay, if this is personal accident, would you say a murder is an accident? I don't think a murder would be classified as an accident.
No, it's not an accident.
Yeah, but it's violent though. But it's not something accidental. I mean, people would purposefully kill you for your stuff if they're murdering you. Well, they're thugs, so they're probably robbing the guy as well. Probably, I guess. But yeah, so let's just check that. Personal accident. If it's not, murder, I don't think is part of it. Okay, personal accident is 137. Okay, yeah, personal accident, the previous cover we looked at all policies of indemnity. However, personal accident is a policy of compensation because it's impossible to put a price on someone's life and therefore impossible to indemnify someone against injury or death. What is covered? Okay, there's a key heading. Personal accident insurance compensates the insured if they are injured or killed by violent external and visible means as a direct result of an accident. Yeah, so then number 4 is out then. So obviously this guy was murdered, which is violent and external, but not a direct result of an accident. So then option 2 must be correct then. Okay, but then we're assuming that the woman's dying because of her accident. I mean, that's a bit strange to die 2 years after a car accident, but it's possible. Maybe she got some sort of, I don't know, maybe it shortened her lifespan. Maybe it's like, I don't know, it's a strange one. I would have just said a woman dying after being injured in a car accident. Putting in 2 years seems a bit strange. Okay, but maybe it was a direct result of the accident, possibly. Yeah, maybe it's a delayed death. So she got in the car accident now. Maybe she was in life support for 2 years. Maybe that's I don't know.
Yeah, true.
Or maybe she's in a coma for 2 years. That's a possibility. Okay. All right. So 2 I would go with there. I wouldn't go with 4 because it's not by accident. Accident is key. Okay, number 8. The following is or are exceptions. Okay, so this is that whole story with exceptions and exclusions. Do you remember what the difference is, Melanie? If I ask you what an exception is, would you be able to explain it?
I think an exclusion is something that cannot be taken out of a policy. If it's an exclusion, it's not covered.
Okay, an exclusion, remember, okay, what is an exclusion? If you think about the word to exclude something, what does that mean?
It's not included.
Correct. So, can you delete that from the policy? Meaning, can you include something that has been excluded?
Yeah, I think so.
Yeah, you can. So, it's actually the other way around. An
Other way
exclusion
around, yeah.
can be deleted from the policy.
Okay.
But an exception cannot, because it always applies. Okay, because remember, companies that are issuing policies want to be very specific about what they don't cover. They don't want there to be a grey area in terms of a debate. They want to explicitly state what they won't cover, because if those events occur, they know they're not going to cover those costs.
Yeah.
Okay, so that's exceptions. Okay, exceptions meaning I'm not going to consider paying out a claim. Okay, so the following is or are exceptions in terms of a liability cover in a domestic policy. Okay, so domestic policy is looking at something relating to your home or your personal, your like domestic, so home sort of, so like house owners, householders, perhaps that could be falling under that. Okay, so let's see. Liability arising from the conduct of business for reward. Liability. Okay, so which of the following is or are exceptions? Okay, exceptions in terms of liability cover in a domestic package. Okay, so if it's domestic, we're looking at the exceptions to it. So meaning things that we cannot delete. Okay, so liability arising from conduct of business for reward. Liability for the death of the policyholder, liability arising from the negligent use of a firearm, liability arising for the consequences of a bad slice at golf. Okay, so we're going to have to check this. Let's check the... Okay, I've got this file open. Exceptions. Okay, this is very specific, so it's probably a list of considerations that we need to... Okay, here's exceptions. What page is this on? 44. No, nothing there. Exceptions, general, specific. Ah, there we go. Here's it. Okay, it's on what page? Page 72. Okay, page 72 of that file that I sent through to you. I think that's in the newer textbook that you've got, but it's here. I can put it up, and it says... The following exceptions apply to liability cover in a domestic package. Okay, it's here. There's it. Okay, so liability for the death or injury of the policyholder. Okay, so we can tick that one. Liability for loss or damage of property belonging to the property holder. Okay, do we have that? Liability. Okay, so death of the policyholder. We can tick that one. So B is true. Liability arising for the conduct of a business for reward. Liability arising from the negligent use of a firearm. Liability arising for the consequence of a bad slice at golf. Okay, so the conduct of a business for reward. Okay, so number A is correct as well. Ownership of land and buildings other than the res. Okay, that wasn't spoken about. Ownership of vehicles and animals other than domestic. They didn't speak about that. Liability that the policyholder has agreed to accept and for which he or she would not have been responsible without the agreement. No, they didn't cover that. And then the consequences of all willful or malicious acts. Okay, consequences of all willful or malicious acts. So willful meaning you were willing to do it. Okay, so what did they have here? Liability arising from the negligent use of a firearm. Okay, that's a willful act. Because you willingly, negligently used a firearm. Obviously, if you're using a firearm, you should be careful.
Yes.
Okay. They want to know which is or are... Okay, so A looks good, B looks good, C looks good. D. Liability arising from the consequence of a bad slice at golf. Bad slice at golf. That's probably like you're swinging wildly or something. So that's also willful. So yeah, I would go with all four of these too. A willful or how did they word it again? A willful or malicious act. Willful. Do I have the right definition for willful? Willful. Okay, so yeah, if we look at the definition of willful, it's intentional or deliberate, having or showing a stubborn or determined intention to do as one wants. Okay, so if you do what you want willingly, without anyone or with even people, let's say, telling you that you shouldn't, but you still do it, and then you injure yourself or you get hurt, then that's your fault in a way. That's pretty much what they're describing here. So yeah, so then all four would be correct here.
Okay,
liability arising from the negligent use of a firearm, or you're willingly using it, and if you're using it incorrectly and you cause harm to yourself, that's bad. And then consequence of a bad slice at golf. I mean, it's willing. Yeah, you're willingly taking a bad slice at golf, so you're probably swinging wildly or something like that. Yeah. Okay, so yeah, I would go with 2 here. Did you go 2 as well?
Yes.
Okay, good. Okay. All right, number 9. What is this? Motorcycle insurance. Okay, here's that whole story with the passengers and no passengers. They always test this. You can sort of see which questions are more popular than others.
Yeah.
Okay, so under motorcycle insurance, there is no cover for the motorcycle if a passenger is being carried on the motorcycle. No cover, yeah, there would be, because the passenger it would be a liability to the driver or the rider. Full cover for the motorcycle and passenger liability can be provided by adding a pillion passenger extension. No. Okay, remember, the passenger is always at a disadvantage. The passenger will never have cover. Cover for theft of accessories and spare parts. No, it wouldn't cover the spare parts and accessories. Number 4, the driver of a motorcycle is covered when driving his own as well as another motorcycle. No. I would go with 1 here.
Yeah.
Okay. Glass insurance. Provides no cover for plate glass shop counters. Provides no cover. No, it would provide cover. Provides no cover for mirrors. Is subject to average. Covers the costs of boarding up windows over after a loss. Provides for cover. Provides no cover. Provides no cover for mirrors. It would cover mirrors. Is not subject to average. It's not subject to average. Covers the cost of boarding up windows after a loss. Provides no cover for plate glass. Oh, okay, maybe plate glass, because remember they spoke about the thickness of the glass. Let's find that again. Commercial insurance. Where is it? Here. Buildings. Personal accident. No, that's personal accident. Commercial. Fire. Business interruptions. Theft. Business all risk. Money insurance. Okay, here's glass insurance. What do they say here? Let's check. The policy is subject to average. So that's actually right. Oh, not subject to average. That one's out. And the sum insured should be the cost of replacing all the glass and windows items. Okay. The rate is a percentage of. There is also cover for damage to windows. The cost, plate glass, mirrors. Basis? No. Okay, so accidental breakage of glass. The cover is really designed for the breakage of place glass windows. Place glass windows. Here they said shop counters. So I think because it's shop counters, there is also cover for plate glass shop counters. Oh no, that is mentioned there. Okay, in the bullets, plate glass shop counters is there. So they said no cover. That's incorrect. There is cover. Provides no cover for mirrors. That's incorrect. It does cover mirrors. Is subject to average. No, we saw that. So it must be the last one. Covers the boarding after a loss. The cost of boarding up is after. Okay, yeah, that is the right one. Okay, it's there in the textbook, page 158.
Yeah.
Okay, let's write that down here on the separate page. What is this? Question 10, hey? Okay, question 10, number 4. Did you go with 4 as well?
Yes.
Okay, 158, nice. Textbook. Save, okay. Alright, hull insurance. Okay, remember hull is looking at the actual boat part of the boat. So, is only available to completed vessels. Yeah, well, you have to have a boat before you can insure it, so possibly. 2, covers the vessel but not the associated machinery. The hull. The hull is the boat. Does it cover associated machinery?
Yes, it does.
Does it? Okay, great.
Yeah.
Okay, so that one would be out. Only covers perils on sea. No, it wouldn't only cover perils on sea. It's for the boat, so it would be damages or loss. Covers collision liability. No, I think it would be number 1 because the boat must be complete. It doesn't make sense for the boat not to be complete.
Check page 89 on the old study guide.
Page 89 on the old study guide. Okay, let's have a look. 70, 81, 2, 3, 4, 5, 6, 7, 8. Okay, here. Okay, marine insurance. 89, hull insurance. Okay, here's hull. Okay, hull losses comprise damage to or loss of vessel. Okay, there, associated machinery, so you're right. Anything that can float, move, occasionally can be classified as a hull. Marine policies are available to cover not only completed vessels, but also those under construction. Oh, okay. So not only completed, but also under construction.
Yes.
Okay, the term hull initially ensures... let's see then.
Yeah, that one about collision is there.
Where do you see that?
The center. It's in the center there.
Oh, here.
The
collusion
center,
liability. Commonly deemed to cover further areas, namely disbursements and collusion liability. Okay, so you're right. Page 89.
Yeah.
Okay, page 89. This was the study guide thing that we said, and then that would give us what option?
4.
Covers collusion liability. Ah, perfect. Okay, so it's not only completed vessels, it's also vessels under construction. That's interesting.
Yeah.
Okay.
Yeah.
Alright, so covers collusion liability number 4. Okay. Alright, in an insurance policy, the cancellation clause will be reflected under. Okay, that's an easy one. Obviously, clauses will always fall under the general conditions. Okay, so 1 should be the right answer for that one. Number 13. In terms of a quota share, okay, quota share is easy as well because there's always a fixed proportion of every risk. So number 1 as well here. Let's just check the others. Risk is shared in a non-proportional basis. No. They share in different parties involved. No. As amount, no. Okay, and then the only amount capacity ensures no. Yeah. So quota share is simple. When I see quota share treaty, I know it's a split. It's a quota share, meaning they've agreed to share a specific portion of every risk.
Okay.
Alright, 14. Indicate the correct statements. Okay, the solvency margin of a company is represented by the capital from shareholders and free reserves of the company. Does it reflect... Okay, solvency would be the capital they have available to pay claims. Yeah, that looks pretty good, so let's keep that aside. Policyholders usually prefer higher solvency. Policyholders would prefer higher solvency, so that is correct. Higher solvency margins indicate a higher utilization of resources. No, it wouldn't, because you're just keeping money aside to pay out claims, so that's wrong. Shareholders usually prefer high... No, they don't. Shareholders want low ratios, so A and B, 3. Is that okay?
Yes.
Okay, question 15. Householders policy, okay, so we're looking at contents. Covers the content of a private dwelling but can also be extended to include. Okay, this is very specific to householder policies. So, extending fire brigade charges, we'll have to check that. Fixed sanitary against chipping, no, that's out because chipping and scratching is wear and tear. accidental damage to television sets and video cassette recorders. This is for what? Householders. So householders is contents. So if it's contents, then it could actually cover television sets because it's contents, and obviously the television set will be part of the house. Okay, so C I would definitely go with. D, personal effects of guests. Let's just check this.
Okay.
This is householders, page 133. Householders, 135. Okay, here, 135, yeah. Extensions to cover. Property elsewhere? No. Accidental damage? Television? Okay, that one's definitely right, because that was fine. Household goods in transit? Okay, personal effects of guests also. Cover rising from household? Cover, okay, fire brigade. Okay, that is also. Okay, so A, C, D is right here.
Okay.
Number 4. Question 15. Great, okay. Alright, 16. In terms of business interruption insurance, the gross profit. Okay, I remember one similar to this that you actually mentioned to me when we were doing those other past papers.
Yeah.
There's a whole lot of different requirements there regarding the business insurance, and they like rated a specific way. Let's just find that page, commercial insurance. Business. Okay, here's it. Business interruption insurance, gross profit. That's what they're referring to here. Calculates on the following basis. Okay, so it's the difference basis or the additions basis.
Basis, yeah.
If it's difference, it's turnover plus stock. Turnover plus stock. Okay, that's there. Less opening minus opening. Yes. And uninsured costs. Okay, that one's almost but not right. Then there must be additions. Net profit plus static charges. Okay, 4. Okay, that's number 4 there. Number 17. An excess claim reserve will result in. Okay, so if it's an excess claim reserve, that means you've got too much sitting in reserve. The loss ratio of the insurer appearing higher than it actually is. Well, yes, because your claim reserve is so high, you would people would expect you to pay out lots of claims, so it'll be higher than it actually is. Yeah. An increase in the share price? No. An increase in investments? No, because you're keeping money aside, you're not investing it. Lower solvency? No, it'll be higher solvency. Yeah, so 1 definitely, yeah. Is that okay?
Yes.
Okay. Question 18. Indicate the correct statement. Under third-party liability cover, no cover is provided for the insured's vehicle. If this is third-party, yeah, it'll only cover damages from third parties. So yeah, definitely correct. Your vehicle wouldn't be covered if it's third-party only. That's risky. Damage to the insured's recovered stolen vehicle will be covered under third-party fire and theft. Damage to the insured's recovered stolen vehicle, will not be covered. It will be covered because that's theft. 3. The first amount payable under motor is cumulative in case of windscreen exit. Cumulative. No, as far as I know, it's not cumulative because the first amount payable is your excess basically, and your excess wouldn't be cumulative. You paid as and when. 4. In terms of the papillion, okay, there's that papillion thing. Cover is provided for injuries? No, never. Okay, passengers are shame. I feel sorry for them. They always excluded. Okay, so be careful. Don't get into someone's motorbike or their sidecar. You're not going to be covered. Yeah. Okay, so 1 definitely. Okay, motor traders internal policies. Okay, if it's internal, it's looking at stuff at the premise. Only cover vehicle damage at the premises of the insured? Well, yes, it's internal, so it would only cover that. Let's see. The next one covers the insured's own vehicle and vehicles in his or her custody. Can be rated on a wage basis. Cover vehicles temporarily garaged in the course of... Okay, so A is out, D is out. B and C... Oh, hold on. A is in, D is out. Okay, so it's B and C that we just need to check. Motor. Okay, motor.
I think D is also correct.
Hey?
I think D is also correct.
Cover temporary garage in the course. No, isn't that external? Let's check that. Motor trade risks. Okay, here's it. Internal policies. Covers only vehicles damaged at the premise. There's it. That's internal. It's that table in your textbook, page 179.
Yeah, correct.
Do you see that?
Yeah.
Okay, yeah. So it only covers, yeah, because it's internal.
Oh, it's internal,
is
yeah.
At your premise, not elsewhere. Because if you're covering vehicles temporarily garage in the course of a journey, that means it's not at your premise. It's somewhere along the journey.
Okay.
That's outside the premise of the business. So that's definitely out. Okay, so A is in, D is out. Which one else is in? Vehicles that are covered. Only the insured's own vehicles that are covered. Okay. Covers the insured's own vehicles and vehicles in his or her custody. That's out. Can be rated on a wage basis. Let's check. Okay, yeah, that's in. Okay, so A and C. A and C here.
Yeah.
A and C is number 3. Page 179. 179 textbook. There's a table. Is that okay?
Yeah.
Okay, so next one, 20. An insurer enters in a quota share agreement. Okay, quota share meaning percentage of. Ceding insurer retaining, with the ceding insurer retaining 60% of any loss. Okay, so the insurer is going to keep 60, the reinsurer is going to have 40. How much will the reinsurer pay if the loss amounts to 80 under 100,000 rand policy? Well, 40% times 80,000 is 32,000. That's easy to calculate.
Mm-hmm.
Do you agree?
Yes.
Okay, option 4 then. Okay, 32,000, 40% of 80,000. Just write that in there. Save. Okay. Alright, is that it? No. Oh, yeah. We have multiple choice now. Okay, so still short questions, no long questions yet. Section B, true and false. Okay, indicate the statement true or false and provide a motivation. Okay, so you need to motivate. Okay, number 1.1. Reinsurance is significant to buyers of insurance because it spreads risk and assures that all insurers will charge the same premium for the same risk. No, reinsurance is completely different. What does reinsurance do? It spreads the risk of the insurer because the insurer is not taking on all the risk. So, significant to buyers of insurance. No, it wouldn't be buyers of insurance. It'll be companies offering insurance. They wouldn't charge the same premium though for the same risk. Okay, so I don't really know how they want you to correct this. I would focus on reinsurance here. I would be discussing what reinsurance is here. So I would definitely say this is false. I would be referring to what reinsurance is. So I would describe reinsurance. Okay, so what is reinsurance? It's basically insurance for the insurer. Almost. Okay, because they're taking policies and they're sharing it with their reinsurer. Did you do something different? How would you correct the statement? Okay, well, did you go with false or true here?
No, I didn't answer these questions here.
Okay, well, yeah, I would definitely go with false here, but then obviously there's a question mark here in terms of how to motivate or correct. So do they want you to focus on reinsurance? Maybe. If they're talking about charging the same premium for the same risk, well, that wouldn't be the case because different policies have different risk levels and different clients have different risk profiles. So your premiums will be slightly different based on your age, based on your history, based on your claims, and so on. Yeah, so it's a bit of a strange question. I would be focusing on the first part, which is the reinsurance. It's mainly for the insurers, not for the buyers of insurance. That seems a bit odd. Okay, but yeah, false should definitely be correct. Just the how you correct is a bit of a question mark. You could take different perspectives. You could describe who buyers of insurance are and maybe relate that to their premium and risk, and then that'll be false. Okay, if you're a buyer of insurance, your premiums and your risks will be different. They won't be the same. Okay, so you could maybe motivate that as well. Okay, but definitely false here. Okay, number 1.2. A farmer issues his crop for 100,000. Okay, remember we learnt about that special condition, that 75%.
Yes.
That 75% thing. Let's just recap what that was again. 75%. Okay, where is it? 75%. Ah, there's it. Okay, so in the textbook bit, in case a 75% condition of average is applied, the insured will share in the loss only if the insured sum is less than the stated 75% of the value. Okay. Alright, so we need to check 75%. Okay, so the farmer insured his crop for 100,000. The value of the crop is 125. A loss of 50 is sustained. The principle of special conclusion applies. 40,000 is payable by the insurer. Okay, we need to check that now. So, 75% of what? Of the value insured. Okay, so value insured, 75% of that is 75,000. What is the loss? The loss
50.
was
50.
So would it be covered? Yes, it would. Okay, so the insurer, they said less than. So the insured will share in a loss only if the insured sum is less than. It's not less than, it's more than. Hold on, let's just check that. 75%, the insured will share in the loss only if the insured sum is less than the stated percentage of the value insured at the time of the loss. At the time of the loss. That all they say. Okay, so let's just try to understand this again. Share in the loss only if the insured sum is less than the stated percentage of the value insured. Okay, which is the indemnity. Okay, so the value insured for is 125. What is 75% of 125? Let's check. 125 times 0.75 equals. Okay, I still get an amount bigger. It's 93,750. Okay, so if we're interpreting what we have here, the farmer has insured his crop for 100,000, 75% out of 75,000. The value of the crop is actually greater than, so he's underinsured. The loss of 50 is sustained. Okay, the loss is less than the sum insured. So here they said the insured will share in the loss only if the sum insured is less than the stated percentage of 70. Okay, so I'm actually looking about this wrong. Okay, this, okay, is 93,000. Okay, 93,000. What is the sum insured for? The sum insured for is 100,000. Is 100,000 less than 93? Yes. So would he share in the loss?
No.
Yeah, he would. Because they said
Yes, he would.
the insured will share in the loss only if the insured sum is less than the stated percentage of the value insured.
Yes, he will.
At the time of the loss. Okay, so he would pay a share. He would pay a share. Is there an example here? There should be. Let's just check. Where was that example we had? Was it this one? I think it was. Yeah, number 2. There's number 2 here. Okay, so a property is insured for 50. The total value of the property is 100. A loss of 25 is sustained on the property. Okay, so in this case,
See the one below that.
the one below it.
Question 3.
Okay, yeah,
Number
we
3.
can look at both.
Yeah, okay.
Okay, that's
But
the pro
this one
rata.
is...
Okay, yeah, let's look at 3 then,
Yeah.
because it's more specific to the one that we're reading.
Yeah.
Okay, yeah. So a crop is insured for 75. Full value of the crop is 100. Crop damage is 20. Okay, so what is 75% of 100? 75,000. Is the damage, not the damage, is the crop insurance less than 75,000? No, it is 75,000. If it was less than, he would share. But now it isn't. It's equal to 75, so the insurer pays out everything. So that's right. Okay, so here, 75% of the value of the crop is that. The farmer insures the crop for 100,000, which is greater than. Do you see that? It's greater than. So
Yes.
will the insurer pay out the full loss? Yes,
No.
they would. They would only share
Well,
if it's less than.
less than.
Yeah, so this would be false. Okay, because the insurer pays out 50,000. Okay, because the insurance is greater than 75% of the value of the crop. Does that make sense?
Yes.
Okay. Alright, so insurer pays full 50k because 100,000 is greater than 93750. Okay. Alright, number 1.3. The principle of contribution applies to policy of compensation. Okay, what is contribution? It's when we have more than one insurance policy from different providers. Do you agree?
Yes.
Okay, so if I'm looking at if I'm looking at the principle of contribution, contribution relates to the policy of compensation. Let's think about this. No, it wouldn't be compensation because compensation would be life cover. So would they pay out a portion? It'll be more indemnity. The principle of contribution applies to policies of compensation. Compensation. We can check this. Let's search for it just now. Let's just find that note. As far as I remember, contribution refers to indemnity because you're looking at putting someone back into the place they were before. Contribution. Okay. There, define indemnity, contribution, subrogation. Okay, so including subrogation. Okay, a number of important consequences from the indemnity requirement. Okay, here's it. Indemnity requirement, including subrogation and contribution. Okay, what else is there? Let's check. Is there anything else? Non-indemnity insurance. A number of consequences arising from the indemnity do not apply to non-indemnity insurance contracts. These include subrogation contribution between co-insurers. Okay, because contribution is a portion of, so they're paying a portion of. So they referred to it here. A number of important consequences follow from the indemnity requirement. So a number of consequences that arise from the requirements of indemnity do not apply to non-indemnity insurance contracts. A number of consequences that arise from the requirements of indemnity do not apply. So it does not apply to non-indemnity insurance contracts, meaning it only applies to indemnity. Yeah, so it would be correct. So here, it wouldn't be policies of compensation, policies of indemnity. Okay, that's how you would correct it. So false again. Policies of indemnity. Okay, number 4. Pooling is not a prerequisite of insurance. It's not a prerequisite, it's just a nice to have because of the law of probability. Okay, remember the law of large numbers? Insurance companies want pooling because pooling is ideal because they can spread the probability across many individuals. Okay, so is not a prerequisite, it's true. Why isn't it a prerequisite? It's just something that will help reduce risk for that insurer.
Okay.
Okay, so it's a nice to have to reduce the risk, but it's not a necessity. It's not a requirement. Okay, so that one's not too bad. That was relatively easy to answer. Let's check the next one. 1.5. In the case of life insurance, insurable interest must be present at the time the contract is taken out, definitely, and when a claim is large. No. Okay. It's only when it's taken out. Remember, it's at inception. Okay, because you need to obviously identify the person you're insuring. So, for example, you can't take out life insurance on a stranger's life.
No.
Okay, because that wouldn't be ethical. Okay, so it's definitely at the time the contract is taken out. Okay, so false here because I don't like the last bit. When a claim is lodged, that wouldn't be applicable.
Okay.
Got that?
Yes.
Okay, number 1.6. A jacket torn while passing a gate on your way to work will be covered under all risk. Well, if it's all risk, it's damage or loss. So this is damage, so it will be covered. I would go with true here.
Okay.
Okay. It's not wear and tear. Wear and tear is different. That's when the jacket gets old. This was actually damage.
Okay.
Okay, you actually ripped the jacket accidentally. Okay, number 7. An insured has a policy with a 10,000 deductible and a recapture factor of 5%. Should a loss of 50,000 be sustained, the insured will pay a deductible of 8. Okay, we need that fancy equation. Recapture. Okay, there's it. Okay, let me take it and put it on my workings that I have on the side here, just so you can see what I'm doing. Okay, let's take a snapshot of this. Okay, let's pull this through. Okay, let me paste that. Okay, so there's the formula. Okay, let's go back to the question. And let's put the question up. There's the question. Alright, so the insured has a policy with the deductible. Okay, so P equals brackets. What's the loss? 50,000 minus the deductible of 10. Close brackets times brackets 1 plus a recapture factor of 5%. Close brackets equals. Copy paste answer. What do we get? Can't work this out. 42,000. Okay, so 42,000 is the payment by the insurer. Okay, so the insured will pay a deductible of 8. Yeah, that would be correct. Okay, because remember, have a look at this. Here's an example. Consider a policy with a 5,000 Rand deductible and a recapture 4%. Okay, what would the insurer pay for a loss of 45? So here's the working. 45 minus 5 times that gives you 41,600. Okay, 41,600 what the insurer paid. What is the loss? 45. So what does the insured pay? The insured pays the difference. Does that make sense? Is that okay, Melanie?
Yes, it is.
Okay, yeah. So here, insurer pays 42,000. Okay, the loss was 45. No, 50 in this case. So the difference is 50, which is 8,000. Okay, so the insured will pay a deductible of 8. Oh, that's actually true then.
Yes.
Okay, because here we had an example where we had 45 minus 4 times that. In essence, the deductible has been reduced from 4 to 5, which is 4,500. Okay, yeah, so that's fine. Okay, so that's okay there. That would be true. Okay. 1.8. Happy with that one?
Yes.
Okay. What does 1.8 say? Insurer underwriting tiresome insured. Okay, fire, loss of profits. Underwriter has a net line of 4 million and can take additional 50 fire and loss. Okay. They've got a 9-line surplus treaty. Okay, that's easy. Okay, so 4 million plus 9 times 4 million. 9 times 4 is 36 plus 4 is 40 million. Okay, so 40 million cover, and they can take an extra 50% plus 50% if the risk involves fire and loss. Okay, so 50% of 40 million is 20 million. So the grand total is 60 million. Okay, so the underwriter will need no facultative insurance. That's false. They will need. Is that okay?
Yes.
Right, so 4 million plus 9 times 4 million equals 40 million plus brackets 50% of 40 million equals 60 million total. Okay, so facultative insurance will be required. False. How much facultative insurance will be required? Well, it's 60 million, so 60 and 60 is 1, yeah, so extra. Facultative of 60 is needed. Happy with that?
Yes.
Okay. Right, 1.9. Now pays the insurance, pays the premium of a short-term policy every month to his broker. Mr. Hugo experienced a cash flow problem, paid over the premium to the insurer during April. Null is involved in an accident. Mr. Null will not be able to claim. No, you will be able to claim. As long as you've paid the broker, you've paid your premium.
Mm-hmm.
Okay, so will not be paid by the broker. Will not be able to claim. That's false. He will be able to claim. Okay, 1.9. Okay, he will be able to claim. Okay, and then 1.10. 1.10. Mr. Naidu had a personal accident policy. He worked in a mine as a shaft manager. During the year, he was diagnosed with lung cancer, which caused his death. His widow was listed as a beneficiary on his personal accident policy, and she will be entitled to claim from the insurer. Yeah, I would go with true here. Okay. Oh, but this is personal accident. Oh, but caused his death. Yeah, possibly. This could be personal accident. He died. Well, but there's no violence here, hey?
No.
He worked during the year. The widow listed as beneficiary of personal accident. She will be entitled to claim from the insurer. Okay, that's interesting. Unless there's a death benefit, let's check personal accidents. Okay, yeah, so if we look at personal accident, they said what is covered is killed by violent or external means, but illness isn't covered. Okay, so this wouldn't be covered, and we can't really call this violent either, so this will be false. Okay, illness not covered under personal accident. Okay, so that's definitely false. Okay, so I shouldn't have highlighted true there. It's false. Is that okay?
Yes.
Great. Okay. Right. Paragraph question, section C. The organization for which you are currently working for has a current ratio of that and an asset test ratio of that. The average current ratio for similar business is 2.1 and 1.1 for the asset test ratio. With reference to these ratios, comment on the business capacity to fund some losses from its working capital. Okay, here we need to refer to those very specific ranges of values. Remember those things part of the self-insurance?
Yeah.
Okay, remember, UNISA is always going to test their own content in the long question. So that's why self-insurance comes up here quite often. Okay, so I need to reference that. I need to go to that page in order to get the right reference, and we can discuss the ratios.
Yeah.
Alright, so in the study guide, there's a note here about self-insurance, working capital guideline is 1% to 25%. Conversely, 10% to 25% should be used when the company has a very liquid working capital position. Okay, so is that the case in this question? Let's go back and check. Are they very liquid? Okay, so point number one. So they said with reference to these ratios, comment on the business's capacity to fund some losses from its working capital. Okay, so I'm first going to compare. So compare the business to industry. Okay, what would you say? Better or worse than the industry?
Better.
Correct. Okay, so better than industry because current ratio and asset test is greater than the industry. Okay, so would you be using the 1 to 25%? No. They could use the 10 to 25%. Do you agree?
Yes.
Okay, because they said here, conversely, 10 to 25% should be used if the company is in a very liquid position. Okay, it's in that paragraph over there.
Mm-hmm.
Okay, it's the last bit over here at the bottom. There's it. Is that okay?
Yes.
Okay, so did they give us other amounts? No, they didn't. They just said, with reference to these ratios, comment on the business's capacity to fund some losses from its working capital. Right, I would then just say they can self-fund 10 to 25% of their working capital. Okay, that's what I would write for this one. Okay, let me label this question 2, Q2. Okay. Sound alright?
Yes.
Okay, let's look at the next one. Question 3. Distinguish between conventional and finite insurance. Give 3 reasons why finite insurance might be considered as a business organization. Oh, but considered by a business organization. Okay, so let's just go to finite. Okay, there's it there. Finite insurance. Where's the... Okay, there, characteristics. There we go. Okay, so distinguish between conventional and finite insurance. Okay, obviously conventional insurance is normal insurance, so that you'd be able to explain. Okay, here they said finite insurance or finite reinsurance differs from conventional insurance. Okay, there's actually a nice paragraph there. That's actually brilliant. Okay, they've actually given you a note there about it. Alright, because what did they want you to do here? Distinguish between, give 3 reasons. Okay, there are the 3 reasons. Reason 1, reason 2, reason 3. functions of finite insurance, you might even want to describe that. Okay, so I'm going to take this, copy that, I'll put that into the Excel spreadsheet. Let's put that there as a reference. Question 3, okay, referenced from the study guide. Okay, and I think those 3 are actually good enough, but you might also want to describe or talk about the function. That's a possibility, which you could, so this is additional. Okay, don't think you have to have it, but I'm just going to put it in. Additional, if you want to, you could talk about the functions of finite insurance, because they are asking you to distinguish between the two. So you might want to define what finite insurance is, because they did say, give 3 reasons why finite insurance might be considered. Okay, so functions of finite insurance. Is anything else that we could include? Let's just check. No, I think that's about it. Okay, so I would just include those points as part of that discussion. I would definitely compare the 2, which is here, these 3 bullets, and then I would maybe describe what the function of finite insurance is, to allow companies to or benefit, okay, from this particular product. Is that okay?
Yes.
Right, let's look at the next one. Question 4. Mr. Baker approaches you to arrange employees' liability cover for him. Assist him by briefly explaining the functions or functioning of the COID Act and how it affects him as an employer. Okay, that's a nice question. We just need to go to COID, page 87. Okay, we're looking for a list. Okay, no list here in the study guide, so there must be a better list in the textbook. So I'm going to use the textbook as a reference rather. The COID Act. Okay, remember, this is all that information about the domestic workers and those people, policemen, and that. It's all the detail there. Where is it now? Okay, chapter 11. Okay, there's compensation, page 194. Okay, there we go. The COID Act. Persons not covered by the Act. Limited benefits. Employee liability cover. What did they want here? They said, Mr. Baker approaches you to arrange employees' liability cover for him. Assist him in briefly explaining the functioning. Okay, so the functioning of the Compensation for Occupational Injuries and Diseases Act. Okay, so you could use page 194 in the textbook. Let's write that down. Question 4. Page 194. Is it in the same page in your textbook or different?
It's page 222 to 223.
222 to 223.
Yeah.
Okay, textbook. Alright, great. And then maybe just to go back to this, let's just see if there's anything here. They are. They're probably going to refer you to the textbook. Yeah, they are. Okay, so even in the study guide, I mean, they've given you a little bit here at the top, but that's not much to go by. There's probably a lot more in the textbook. Yeah, there's not much here that you could actually use. Unless it's a separate question. Describe the cover provided by COID. Sometimes there's even questions and answers in the study guide, and they literally take it straight from the study guide. But I don't think it's the case here. No. Okay, yeah. So the best bet here would be to go to the textbook, okay, to reference those pages that you've mentioned. Okay, obviously COID is for people that are going to be working in, let's say, environments that could be potentially harmful to them, and they would receive compensation from the government, basically, so that avoids them suing their employer. Right, so if we're looking at briefly explain the functioning of COID, Well, there's actually a lot you could mention here. It's for 5 marks, so it's not too bad. But obviously, as an employer, Mr. Baker's best, let's say, motivation for using it is that he's not going to have liability as the employer. Okay, by arranging this compensation for Occupational Injuries and Diseases Act. It helps him actually. Okay, because in the past you could sue your employer for almost anything. Now it's limited in some ways because you can only claim, alright, from government in order to protect the workers. Okay, so government has now put measures in place to ensure that workers are protected. Okay, because obviously employers and employees, yes, there's a relationship between the two, but employers also don't always want to pay out because it affects them, but then employees always want to get paid out if something is harming them. So it's a bit of a conflict of interest between the two, because the one has different focuses or focusing on different goals, and the others focusing on different things as well. So just to recap some of the theory, people who are undergoing military service or military training, okay, they aren't covered by the Act. The police, SAPs and Defence Force, not covered under or when they're under active service. Contractors, people who carry out contract work, not covered. And domestic employees also not covered. Okay, so there's quite a bit there. I think reference the textbook, that will be best for this question.
Yeah.
Okay, define proximate cause and explain by means of a practical example. Okay, they even gave you an example in the textbook. I remember we discussed a question about the fire, or was it the fire? No, the gale force wind. It was the wind that damaged the property, and then they were arguing, was it the wind or was it the fire? Okay, so let me get the page reference for that.
It's 285 on the new textbook.
Okay, great. Page 285. Okay, I think it might even be in here. Proximate. There we go. Proximate cause. There we go. Proximate cause. Did they give an example here? No, they didn't. Okay, but you can describe it here. Okay, so here's the definition for the proximate cause. Cause of loss, establishing a connection, all of that. Okay, so we can reference that from the study guide. That's something that you would define, and then you would give an example that would meet that definition that you've written. Did they give something here in the textbook? No, they didn't. It was definitely in the study guide. The textbook definitely gave a note about the proximate cause. Okay, what chapter is the proximate cause in?
Claims procedures.
Claims procedures. Oh, there we go.
Chapter 6.
Yeah, chapter 6. Claims department, valid claim. Okay, so let's go to page 96 here. The dominant cause, proximate cause, there's it. And they give you the legal definition. And then they talk about the fire and the wall collapsing, and the gale force wind. Yeah, so you could even use one of those cases.
Yeah.
You could use Gascarth versus Law Union or Escott versus Railway. Yeah, so you could even use one of the cases. Let me just write the cases down. Okay, I'm just going to write there, refer to the cases as examples, page 98 or page 285. Okay, happy with 5?
Yes.
Alright, number 6. What is 6 looking at? Let's have a look. You have insured your house for 2 million with ABC. You transfer your bond to another bank. You take out insurance with DEF. You do not cancel your insurance. Okay, so now you've got 2 insurers. The actual value of your house is 2 million. A fire breaks out, causing damages of 500,000. Calculate the amount payable by each insurer. Explain the legal principle that applies when an insured is insured. Okay, that's contribution. Okay, so we can just find contribution and we can write all of that stuff down. Okay, that's what they're wanting you to describe here. Contribution. There's the definition. Okay, so all of this would be applicable to contribution. Page 38. This is question 6, right?
Yes.
Okay. Study guide. Okay, so we first need to define it, then we need to do the calculation. Okay, so let's discuss the working. Alright, so you've got 3 million cover here in place, and the actual value of your house is 2 million. Alright, so ABC is going to pay 500,000 times 2 million over 3 million. Okay, so 500,000 times 2 over 3 is 333,000. Okay, so ABC is going to pay 333,000. Okay, and then obviously DEF is going to pay the difference. Let's see what that works out to. 500,000 times 1 over 3 million times 1 over 3. That gives me 166. Okay, so DEF is going to pay 166 or 67 if you round off. Is that okay?
Yes.
Number 7, explain the cover provided under the minor and major limit of money insurance. Okay, this is very specific to money insurance, where we had those limits. I think the limit, if I remember offhand, was around 5,000 for, was it 5 to 20? Let's just check. 5,000 for some reason is popping into my brain.
5,000 is correct.
Yeah, okay. Let's just see what it is though. The details. Okay, there's money insurance. Okay, yeah, there. Okay, that's the minor limit. What's the major limit? Okay, there. Major limit is the full sum assured. There we go. Perfect. Okay, so nice, easy question to answer. Question 7. Okay, it's page 156, textbook. In yours, what textbook page number is it?
184.
184. Okay, brackets, money insurance. And minor limit is 5,000. Major limit is sum assured. Sum assured. Insured. Okay, and then you would describe that as they've mentioned it here. Yeah, it's restricted to a amount of 5,000, provides cover for money while in custody of the directors, while at the home of any partner or director, whilst on the premise of the insured. Okay, great. It's a nice question there as well. Straightforward. Okay, Melanie, and that's the end of October, November 2015. Not too bad, hey?
No.